So good morning, everyone. My name is Mike Ricardo, and I'd like to thank you for joining our webinar today. This is the fourth in ShareVault's webinar series, and today's topic is navigating later stage venture financing complexities. Today's presentation is especially timely given today's venture capital investing climate. Later stage companies are challenged today to raise additional capital, especially if they have multiple rounds of past financing and a complex capital structure. During the presentation, your individual audio will be muted until the question and answer session begins in order to minimize background noise. There will be a question and answer session after the presentation, and you'll be able to submit questions via the question box located in your control panel. After the webinar is complete, we would appreciate your response to a follow-up survey. Now let's get started. I'd like to introduce Tim Harris from Morrison Foerster in Palo Alto, who will begin the presentation. Tim.
Thanks very much. Thanks very much for joining. I'm the head of the technology group here at Morrison Foerster, as a part of our emerging companies and venture capital practice group, where I represent venture capital firms and other investors in startup companies, as well as the startup companies themselves in their investment activity. And I have a particular specialty that we're going to be touching on today, which is modeling complex capital structures, financing scenarios, and liquidity events. You can see the rest of my interesting bio on the slide. So let's go ahead and get into the topic here. Although seed stage investment has increased significantly in the fourth quarter of 2010, extending into the first quarter of 2011, later stage investment activity has continued to dominate the venture investment activity, at least from a dollars perspective, since the contraction in venture capital that occurred starting in October of 2008. Now, these later stage financings require companies and investors alike to structure transactions against a backdrop that's marked by prior investment terms, valuations, and investor engagement that are not always consistent with current valuations and current levels of investor engagement. So today we're going to take a look at how the present meets the past and how sometimes history actually gets rewritten. We're going to start by talking about down round antidilution adjustments, which occur when lofty valuations of prior rounds are brought back down to earth in current valuations. We're going to talk about recapitalizing prior investments, which is really where the rewriting history comes into play. We're going to talk about pay-to-play financings. And these are not the types of unregistered or registered broker-dealer activity that the New York Attorney General's been investigating and pursuing. But instead, in the private financing world, these are transactions where we separate the committed investors from those who have gotten tired and fatigued. So in the game of poker, this is trying to separate those who are going to remain in and those who are going to fold. And then we're going to finish by talking about capitalization modeling, which is a topic that we'll hit in each of the first three categories. And this is where we'll talk about blueprinting the transactions. And really, this is where 90% of the effort is involved. So let's jump right in and talk about down rounds and the mechanics in down rounds. So what a down round is an equity round of financing at a valuation that is lower than one or more of the prior equity financings. Classic example would be a company that's done 3 rounds of financings at $1, $2, and $3 a share, and either due to market conditions or due to execution issues at the company, or just due to evolving thinking as to evaluation of a sector or a particular company, they can only raise money in the D round at 50 cents a share. So the issue here is that the Series D investors are getting twice the ownership interest of the Series A investors by putting in 50 cents a share. In other words, they get 2 shares for every $1 invested. They're getting 4 times the ownership than the Series B investors per $1 invested, and 6 times the Series C. Now, unlike the public market, where investors bear the risk of valuation declines, in the private world, in the venture-backed world, venture investors negotiate in advance either partial or full protection from this kind of decline. Now, your knee-jerk reaction might be, why don't we just give the Series A investors and the B and the C investors more shares of stock to put them in the same position as the Series D investor? And it turns out that there are both tax and corporate law problems associated with sort of giving out additional shares for no additional consideration. So instead of giving out additional shares, what we do is we adjust the conversion rates of the A, B, and the C. For those who've worked with a company that's been backed with both preferred stock and common stock, you'll remember that preferred stock is always convertible into common stock at some rate. Initially, that rate is 1-to-1, but when we do a down round, we adjust the rate so that the preferred stock gets converted into something more than one share. On the next slide, you'll see what an antidilution adjustment is. It is the adjustment of the conversion rate that I just mentioned. And there's a very important golden rule. There's one or two things that you leave this webinar with. I want you to leave with the golden rule of venture finance. And that is, an investor in any round, particularly a down round, must end up owning an ownership interest in the company for his, her, or its new investment that is equal to the portion of the post-money valuation attributable to that investment. So if someone's putting in $2 million on a company that's valued at 8, they should end up owning 2/10 or 20% of the company. That's true in an up round, a flat round, or a down round. You don't ever want to be on that side of a transaction where you pay for 20% of a company's post-money valuation but walk away with 19% of the company's equity. We're going to see an example of that on the next slide. You need to be aware of a phenomenon that I call the death spiral, which is what happens when the conversion rate adjustments of the prior series of preferred stock need to be taken into account when figuring out the price per share of the securities to be issued in the down round. Let's take a look at that death spiral here. You start in the upper left-hand corner where you compute the price per share. So in our prior example, this is the Series D round. That price per share is simply the quotient of the pre-money valuation divided by the fully diluted number of shares outstanding, sometimes referred to as the pre-money capitalization. You come up with a simple price per share. If that price per share triggers any adjustments of the prior series of preferred, you need to recalculate the conversion rates of the previously issued preferred. Now, if those conversion rates change, your pre-money capitalization has now increased. And the number of shares in your pre-money capitalization, that is in your denominator in the upper left corner, has now gone up. Well, with an increased denominator, you've got a lower quotient. So your price per share, in fact, is lower the second time through this loop. You now figure out your new price per share. That, in turn, triggers another anti-dilution adjustment. That triggers further adjustments to the conversion rates. That results in an even larger pre-money capitalization. And you keep iterating through this death spiral over and over and over. Let's flip to the next slide and take a look at how spreadsheets can help us solve this, this seemingly unsolvable mechanic. This is a grossly simplified spreadsheet. So here's the footnote disclaimer. The spreadsheets that you create and that we'll be looking at in these financings can be 30 or 40 rows across to the side and 30 or 40 rows going down the bottom. And for presentation purposes, I've eliminated, I've hidden, or I've deleted an awful lot of rows. But here's an example of a down round that was handled incorrectly. You'll see, as is the case in most capitalization models, the company's pre-money financing on the left-hand side and their post-money financing on the right-hand side. When you take a look at that, you'll see here that this company has a pre-money valuation of $4 million, and they're raising $1 million. Now you'll notice that their pre-money capitalization is $7 million. That's the fully diluted number in the lower right-hand corner of the pre-financing table. So your price per share, the simpleton, would simply calculate the pre-money valuation of $4 million by 7 million shares outstanding, and you come up with 4/7 or 0.5714. This simple approach, however, fails to take into account that the Series A preferred stock, which was issued at $1 a share, you can see from the column header, is going to be adjusted. It's no longer going to be convertible 1-to-1, but 1 to 1.093750. It's beyond the scope of this simple webinar to tell you how that conversion rate occurs. The company's certificate of incorporation will have a very long paragraph setting out in gory detail what the numerator and what the denominator is of that quotient to figure out the new conversion rate. But suffice it to say, it ain't one-to-one. So here, you'll see if we use 0.5714 as the price per share for Series B, the number of Series B shares issued is 1.75 million. And when you look over on the far right-hand side of the cap table, you can see our Series B investor, Banana, with the 1.75 million shares, only holds 19.79% of the company. This is where the siren needs to go off in your head. Banana put in $1 million out of the $5 million post-money value and therefore should own 1/5 of the company, or 20%. When we handle transactions at my firm, we build these models, and I actually put this golden rule, I don't always label it as such, but we put this at the bottom of the cap model. You'll see it as the last 2 rows of the table. We compute what the ownership of Series B should be on a common stock equivalent basis, that's CSEs, and then we compute what the Series B ownership should be on a dollars basis, 1 million in this case divided by 5 million. If those two numbers don't match, you got a major problem, and you should stop your transaction right away. Let's flip to the next slide, and you'll see how a down round is done correctly. Here you'll see the same financing, the same $1 million being invested at a $4 million pre. But here you'll see that the Series A conversion rate of 1.096773 is taken into account. In other words, the 1 million shares of Series A preferred is actually counted as 1.096773 million shares of common stock equivalents. So our Series B price per share is not 4/7. It's 4 million divided by 7 million plus 96,773. You can see that we've got symmetry here and balance in our cap table model, because Banana Ventures ends up owning 20% of the company's equity on a share basis, and lo and behold, that's 20% of the post-money valuation that Banana puts in. Believe it or not, on this next slide, although you've got a lawyer speaking to you, this is the only legal slide that I'm going to show, and this is for the benefit of the few lawyers that are in the audience. These down rounds tend to be marked by horrible conflicts of interest, mostly because these down rounds are usually insider-led. In an insider-led down round, you've got a conflict of the fiduciary duties. You've got your directors on the one hand who are looking out for the corporation and the best interests of all of its shareholders, trying to minimize the dilution occasioned by the new money. And then you've got the self-interest of the director, who often is a representative of the venture capital firm that's backing and supporting this company. And his or her fiduciary duty there is to get the best deal possible for his or her money, and that's a duty owed to that venture capital's limited partner, that venture capitalist's limited partners. So there are a series of statutory procedures that your lawyer can help you work through, and this is important whether you're the entrepreneur and on the company side of the table, or whether you're the investor. In both cases, you want to really minimize your litigation risk. And you'll see at the bottom of the slide 5 common bullet points. Sometimes you can achieve these things, sometimes you can't. A disinterested lead investor goes a long way, especially if that disinterested lead serves the price-setting function. A clear record of a thorough search for a disinterested investor, even if you're unsuccessful at finding one, is better than just raising money from insiders without going to the outside world. A rights offering to let all investors participate is helpful if you can do it under applicable securities laws. And then disinterested approval of a committee of your board or disinterested stockholder approval is also helpful at mitigating potential claims. So let's move on to recapitalizations and recap mechanics. So recapitalizations are transactions that are architected, unlike a down round where we're just layering on a new security, Series B in our prior examples. Recaps tend to go back and look at the A, B, and C round and rework those ownership interests, and often rework the rights of A, B, and C. They're really architected around their desired effects on 3 criteria is what I most often see. Liquidation preferences are either tinkered with or left alone. Priorities among the prior series preferred are tinkered with or left alone. And the valuation differentials of the prior series are tinkered with or left alone. And for those who don't have a strong background in venture finance, The liquidation preference, these are simply the rights of the preferred stockholders to get their money out of the company upon an acquisition before the common stock. So you most often hear of liquidation preference expressed as a multiple. For example, 1x my money back before common gets anything. Priorities is simply whether it's last in, first out, so C gets money back, then B, then A, then common stock, or whether A, B, and C are pari passu and get their money back ratably on an even par with each other before common. And the valuation differentials we saw when the A, B, and C investors in our prior example invested at $1, $2, and $3 a share. Are we going to continue to respect the fact that Series A came in when the company was worth a lot less, or are we going to reset valuations and treat everyone as if they came in at the same time? Now this next eye chart here shows you if you accept the proposition that recapitalizations are structured around those three axes that I described, you've got 2 cubed or 8 different possibilities. And you're either preserving or eliminating each one of these attributes that I've just described. On the far left-hand column, if you preserve liq prefs, priorities, and valuation differentials, you don't have a recap at all. That's just a garden variety D round on top of the A, B, and C. On the far right-hand side, you've got a wipeout, where you're going to eliminate liquidation preferences, you're going to totally eliminate priorities, and you're going to eliminate valuation differentials. And then in between those two, you've got sort of every combination. We're not going to go through every one of those in our limited time this morning, but I do want to show you a couple of examples of recaps. The first recap that I want to show you is the valuation reset. The valuation reset is a transaction in which we redesignate all of the prior preferred, which are often lettered, into Series 1, Series 2, and Series 3. And in this case, we're going to do it by dollars invested in the prior preferred. And we're going to do this because we're going to eliminate the valuation differentials that those 3 series came in under. Now, the Series 1 investor is going to be unhappy about this because the Series 1 investor will say, hey, I invested 3 years ago when there was all the execution risk at a lower valuation. You're now only going to give me credit for the dollars that I've invested, and as a seed investor, my investment was smaller on an absolute basis than the last round of Series 3. We'll preserve liquidation preferences and we'll preserve priorities, so we're not going to monkey with those 2 attributes. And we'll simply raise new money by selling Series 4. So a picture is worth 1,000 words, and when I describe valuation resets as one mechanism, very often my clients, whether they be venture capitalists or entrepreneurs, say, show me what it looks like. This is another. If you walk away with the golden rule being one takeaway nugget, I want you to walk away with the second key point, which is I don't know how people architect recapitalization transactions without mapping them out like this. You've got to see on the left-hand side the starting point of the company, and then you've got to see on the right-hand side the end point of the company. Now again, there's a lot of mechanics that you can't see here going from the left side to the right side, but just very briefly, you'll see that the $1 per share Series A preferred that Apple held gets mapped over into 5 million shares of Series 1. The $2 per share Series B that Apple had gets mapped into 2 million shares of Series 2. And the $3 per share Series C stock that Apple purchased gets converted into 2.25 million shares of Series 3. So you'll see I'm doing this by dollars invested. The same is true for Banana, and the same is true for Citrus in their investments. Along comes the Series D investor, Daisy, and we have to figure out what the price per share is that Daisy is going to invest. It turns out that can be a mathematically difficult problem, but you go back to the golden rule. And you say here, Daisy, what price per share do we need to sell you, your Series 4 preferred stock, so that you end up with an ownership interest that is exactly equal to the portion of the post-money valuation that you're contributing? Now, you can't see the dollars invested here by Daisy, and you can't see the pre-money valuation, but trust me when I tell you that Daisy invested 24.28% of the post-money valuation. And lo and behold, excuse me, Dairy, not Daisy, holds 24.28% of the equity. Turns out that that price per share is this very odd number of 0.5757. So you can always see that you're dealing with the recap after the fact when you take a look at prices per share that have these really weird, odd, non-round numbers that are often carried out 5 or 6 decimal places. So this is a recap where ownership is recast as a function of dollars invested without regard to the different valuations at which those investments were made. Let's take a look at a preference reset on the next slide. Here it is in words. The preference reset is often, it's a simple one to understand. We're going to reduce liquidation preferences, not eliminate them, but we'll reduce them. We're going to preserve the priorities amongst the various series of preferred, and we're going to preserve valuation differentials, unlike the valuation reset. But we're simply going to take all of the preferred stock preferences, sometimes referred to as the preferred stock overhang that's sitting on top of the common, and we're going to scrunch it down. Often the scrunching is done ratably. Let's take a look at what that looks like in the next spreadsheet. We sometimes refer to the preference reset as squeezing elephants into a telephone booth. We've got a company here. You'll recognize the company's cap table on the left-hand side here. They did a $5 million round at $1 a share. They did an $8 million round at $2 a share for Series B, and a $15 million round at $3 a share in Series C. When you sum together those three numbers, you've got a company that has $28 million in liquidation preference if we assume that A, B, and C have simple 1x preferences. If you're looking at a company whose most optimistic exit scenario now is something like a $15 or a $20 million exit, you've got common shareholders who have absolutely nothing to gain at this company because that $15 or $20 million of acquisition proceeds would go entirely to the A, B, and C stockholders. So along comes a preference reset, and you can see that what's happened here. The right-hand side, the post-financing cap table, really was no change. We can see dairy investing 6 million shares at, I believe this is $1 per share. But most notably, the liquidation preferences, which we've summarized on a pre-money basis just below the table. You started at 28 million. This company underwent a 40% diet on liquidation preferences, or haircut, so that the $5 million preference of Series A got chopped down into $3 million of preference. The $8 million of B went down to 4.8, and the $15 million preference of Series C got haircut down to $9 million bucks. So this company took 28 million of preference and crammed it into 16.8 million of preference. Series D, who's the new investor, obviously is not going to tolerate any haircut and is going to want $6 million of preference for its $6 million of investment. So when added to the $16.8 million of reduced preference from the haircut, you got a company that leaves this round with $6 million of cash in the bank to live to fight for another day and only $22.8 million of preference. So this is a company which, if it can sell for $25 million, there's a chance that employees get a little bit. Here's where I'll just point out, I'm not going to go into an explanation row by row, but if you look at the bottom of the table here, instead of showing you price per share calculations, I show you the exit analysis. Again, I don't know how people architect recapitalization financings without a view to the exit. This is all about the exit. So having a beautiful post-financing cap table is great, but it's only half the job. You've got to have a model that allows you to type in different exit prices. My CEOs and CFOs love, when they're looking at a financing structure, they love to take a look at what ownership is after the financing is done. They love it even more if they can start typing in, what if I sell at 30? What if I sell at 50? What if I knock the ball out of the park and sell at 200 million? How are the exit proceeds shared? So often beneath this simple cap table, you'll see a very sophisticated set of analysis to show that exit. Here you'll see the employee take at a $30 million exit, started out at being not much at 400,000 bucks and ends up being about 3 times that amount. And again, that's with a company that raised $6 million and diluted everyone's ownership by 24%. So that's not a bad result. Let me finish on recaps by going to the wipeout. Some people call this a restart. This is also a pretty easy transaction to describe and to comprehend. This is where you simply wipe out the preferred stock and you convert some or all of the preferred stock into common stock. Very often for simplicity, and so people don't confuse our new Series A with our old legacy Series A, I like to wipe away the A, the B, and the C, just turn it all into common stock and sell Series 1 preferred stock. So this totally eliminates liquidation preference. This totally eliminates the priorities amongst the preferred stock, and it puts your investor, it puts all your prior investors in the same position as your employees. Let's take a look at that in the next spreadsheet. Pretty simple. You've got the same starting point for the pre-financing capitalization that we've seen now several times. This company did a $5 million A round, an $8 million B round, and a $15 million C round. So they go into this transaction with the same $28 million of preference that we saw a few minutes ago in the preference reset. But here, there's a massive loss of liquidation preference. Look at Apple Ventures. They start out with 6 3/4 million shares of preferred stock, and they end up with 6 3/4 million shares of common. Because this wipeout is done on a one-for-one conversion basis, there's no change in ownership interests on the far right-hand side. There is, of course, dilution here that's occasioned by dairy coming in for 6 million shares of Series 1 at $1 a share. But Apple, Banana, and Citrus have not lost any ownership interest. They've been diluted a little bit by dairy. Of course, they've suffered a complete loss of their liquidation preference, and therefore a complete loss of their economics in a downside scenario. Now, in an upside scenario, if this company sells for an acquisition price that approaches infinity, Apple Ventures is not harmed at all. They're going to own 27.55% of the company. So they give up their downside protection, they don't lose any of their voting power, and they don't lose any of their upside potential. You'll see in the exit analysis beneath the cap table how there's this dramatic reduction from $28 million in preference down to only $6 million in preference. And again, that significantly helps to the tune of $3 million. That significantly helps your employees here, in this case, in a $50 million modeled exit. So some people call that a fresh start. Moving on to our third topic, which is the pay-to-play. This is really just a wrinkle on the different recaps. Pay-to-plays are triggered by an investor becoming fatigued and not participating in a new financing. And pay-to-play mechanics are structured all around rewarding those investors who do participate and punishing those investors who don't participate. So I'll leave it to you whether you want to view this as a stick or a carrot. Lots and lots of different variants, and many of these variants use the same recap mechanics that we've already talked about. And then for the lawyers in the audience, these can be implemented either through your existing charter or by amending your charter, or sometimes they're implemented by contractual exchanges of securities by your prior investors with the company. Let's flip, and I'll talk here about the two most common pay-to-play structures that you see. At the top of the slide, converting non-participants into common stock. Somewhat of a harsh penalty. The two variants here are that you can convert a non-participating investor either entirely into common if they fail to participate, or you can give them partial treatment. If they participate and buy half of their pro rata share, for example, you might only convert half of their preferred stock into common. And the conversion can either be done at their existing conversion rate, which may give them the benefit of prior antidilution adjustments, or you might do it at a one-to-one conversion rate and deprive them of a prior antidilution adjustment. Or you can do a really harsh thing, and you can convert non-participants at a 1-for-10 or 1-for-20 rate. That really squishes their ownership interest down into a small number. So very much like the wipeout recap that we saw, but this is implemented in a discriminatory manner, holder by holder, depending on whether or not they've participated. Alternatively, you can convert non-participants into a shadow series of preferred, sometimes identified by putting a -1 after their name. And the shadow series might mimic the underlying series exactly and have all the same rights, privileges, and preferences, but you might deprive it of 1 or 2 significant rights, like protective voting rights, or rights to future antidilution adjustments, or some portion of liquidation preference. There is a variant of pay-to-play transaction, which I call the complete redesignation, where you not only convert the non-participants into a different security, but you actually convert the participating investors into a different security so that nobody ends up holding shares that they originally started with. So this is like a complete redo. It's a total facelift on the company. In this redesignation, you often see non-participants converted into a Series 1, which I call the junior-most preferred stock. It may have some liquidation preference, but otherwise it'll have no antidilution protection and perhaps no participation rights. The participating investors get their A, B, and C converted into A1, B1, and C1, where they get to preserve all of their prior preferred stock priorities and all their voting rights and all their board seats. And you go ahead and you sell Series 2 stock to your new investor. And you can do this complete redesignation by converting people either by shares held or by dollars invested to either tinker with or not tinker with the valuation differentials that we saw in the recap. So flipping to the next slide, you'll see the complete redesignation. Again, this is the same cap table that you've seen for the prior in the prior transactions. Here, our non-participating investor, Apple Ventures in this case, gets all of their A, B, and C stock converted into the junior preferred called Series 1. And that's done by dollars invested. So Series A put in $5 million, $2 million, and $2.25 million respectively in the A, B, and C round. That all gets redesignated as 9.25 million shares of a $1 junior preferred stock in Series 1. Our participating investor here, which is Banana, you can see Banana is buying some Series 2 stock. It's an odd number, but that's probably Banana's pro rata share. Banana gets its Series B converted into B1 stock, again on a dollars invested basis. So 3 million shares at $2 a share of Series B gets mapped over into 6 million shares of B1. And their Series C stock undergoes the same mapping. And you can guess here that B1 and C1 are going to have senior liquidation preferences, and Series 1 is going to be somewhere at the bottom of the stack. It's still going to be senior to the common stock. So Apple's not totally unhappy here. You'll notice that Apple's 36% ownership interest before the financing, they do end up with 21% after the financing. So it's still an interesting number to keep Apple interested and engaged in the company. Maybe they'll change their mind and invest in some future round. And it still does preserve their $9.25 million of liquidation preference, which might allow Apple Ventures to avoid a write-down on its books of the value of its investment. And then the last thing I'll point out here is our sale of Series 2 preferred stock, which is the very last row of the table at this odd number of 57576. Golden rule is baked in there. We've got to make sure that Citrus here gets for its Series 2 investment. You got to make sure that they buy 15.01% of the company, because apparently they contributed with their new investment 15.01% of the company's post-money value. So that's a lot, and I'm sorry to rifle you through some very complicated spreadsheets and some very complicated math over a matter of minutes. As you can see, capitalization modeling is just key here. Spreadsheets are absolutely fundamental, and when I do these transactions, it's not unusual for 90% of my time to be spent drafting blueprints of these transactions in the form of these capitalization models. It really is the architecture that has to be fully completed and agreed to by all the parties before you start breaking ground on the construction project. To build these capitalization models, you really have to understand the constraints of the problem that you're trying to solve and the attributes of the desired solution. Now, sometimes clients will say to me, I want a recap that preserves everyone's liquidation preference, preserves everyone's ownership interest, and ends up with the prior investors owning 70% of the company, the employees owning 20% of the company, and the new investors owning 30% of the company. And I stop them right there and I say, I don't need to build a spreadsheet to tell you, those are internally inconsistent problem constraints. Something's got to bend here. I can't break the rules of math. So these spreadsheet models, it's all about showing your existing cap structure and then showing all the different mechanics of your later stage financing, whether it's a down round, whether you have a pay-to-play feature, whether you're recapping, and then showing the pro forma cap structure that comes out on the other end. And there's a ton of iteration that goes on here. You've got to show the antidilution calculations, and everyone needs to sign off on those. There is very limited ability to go back and fix it after the fact if you get it wrong. In the second bullet point, you really got to focus on the ownership percentage, because this will tell you how voting control of the company and how the sharing of the acquisition proceeds of the company will play out in the future. And you've got to confirm that you're not breaking the golden rule. These cap table models are very helpful in terms of revealing the sensitivity of various inputs. I've listed those in parentheses. I will very often have an investment banker or an investor or a CFO at the company that will say to me, hey, I think you can satisfy all the constraints of the problem if you either shrink the size of the round or if we nudge up the valuation of the round, or if we shrink down, for example, the increase to the option pool reserve for management. It's really helpful to build the model. I cannot, in my simple brain, keep track of 6 equations with 6 unknowns, but Excel can do that for you very, very easily. And if you're facile with Excel, you can build these models that will allow you to turn these dials and knobs and see what level of sensitivity you have on those inputs. And the what-if analyses that these cap models afford you are invaluable when you're looking at these transactions. So it's key that these capitalization models be built on accurate capitalization info. You build a model on garbage as the left side of these cap table models. If your pre-money capitalization is wrong in any respect, everything else that follows it is going to be garbage. You got to be very careful and beware that you're building a model on an outdated cap table or an outdated stock ledger when someone else at the company might have a more current ledger. The cap table models, they're always most reliable when you build them directly from primary source documents, primary capitalization documents. And it's most convenient when those are aggregated. They come from a lot of different sources inside of most companies. And if you have a data room like the ShareVault data room, and a company is organized, you can get all of this stuff in one place. And you'll see there in the bullet points all the different things that you may have to look at in order to build an accurate capitalization model. So let's finish by talking a little bit about data rooms. Ready access to the latest versions of all the relevant documents is key. Not surprisingly, I get called in on Friday night and on Saturday night to start taking a look at recapitalization or down round models, usually when companies have run out of money or are close to running out of money. And there's often a lot of time pressure on these transactions. There's a payroll that needs to be met. There's debt that has to be serviced. There's rent that has to be paid. You got to move quickly. This is not a good time to be running through the fire drill of scrambling around. When I say to either an investor client or to an entrepreneur client, I need to see all of your stock option agreements. I need to see your option pool. I need to look at these specific warrants. Don't just give me a number of shares and tell me to trust that it's right. I got to know if those warrants have antidilution adjustments or preemptive rights baked into them. I have to see all these things so that the left-hand side of my model works. The version control problem is a horrible one. Too many of my CFOs will give me a cap table that they think is accurate, and then I'll find out later that somebody in HR knows of option exercises that have not yet been propagated onto the cap table. So if you have all of those in one place inside of a company, not only do you get better access to these docs in the scramble when you need them, but you just get better internal decision making. A data room or a central repository allows all different parts of a business, even a small business where everyone can fit in one room. It allows everybody to see everybody else's work. Your ability to control and monitor access to these documents is key. Sophisticated data rooms like the ShareVault data room product will allow you to grant selective access to people. I've been able to build cap table models in 1/10 the time for an organized company that's got a good ShareVault data room than a company that is blasting me piecemeal with documents from different sources throughout the weekend. So if you're a company that has good corporate hygiene and you're using a data room to impose organization on this otherwise chaotic data set that comes from finance, HR, sometimes it comes from the CEO's desk. You have all that stuff in a data room because, realistically, you did not view your Series A financing as the end of your company's capital life, and you're contemplating either another round or an acquisition. It's just really easy to provision that data room to give me selective rights. And if I'm investors counsel and I'm trying to build a model on your company's data room, I don't know that you want to give me universal rights to everything. It's surprising some of the stuff that gets sent my way and some of the access that I'm given by companies when I'm investors counsel, and all I really need to see is the capitalization stuff. The last point is the process intelligence that can be gained from monitoring access to the data room. If you're a startup CFO and you've got a term sheet here and you know that the investors counsel is me and I'm working on a cap table model and I haven't access to your room over the course of the weekend, you know that you got something to be worried about. As opposed to if I've been in that room 9 times over the weekend and I spent 15 hours in there, you can rest assured that the investors are really digging in and are planning on giving you a term sheet and a transaction structure that works. So with that, I'm going to hand it back over to ShareVault, and John Badger is going to illustrate for you the power of using some of these tools.
My name is John Badger. I'm the VP of Marketing and Product Management here at ShareVault, and what I'd like to do is take just a couple of minutes to show how a ShareVault virtual data room can be set up for the kind of scenarios that Tim just took us through. Very often a company has got a data room set up for the purposes of a corporate repository, and also that kind of a data room is used for each of the rounds of financing that occurs and for the due diligence that occurs at each one of those stages, as well as for investor communications. So now the question is, you're in the midst of a recap, you've got this complex document review going on, and you want to be able to loop in expertise in order to make decisions on this recap. So let's take a look at that kind of a scenario here. So I'm going to switch over to Firefox and get back into this session. And I'm in a ShareVault right now, and here we have over on the left your due diligence list, the sections 1 through 14 of the way your data room is organized. And you'll note here that there's another section that we've just recently added for the 2009 recap, right? So I expand this, and you can see the various types of documentation that Tim referred to during his presentation that is underneath the recap. Now, now we'll take a look at these recap documents like this. Here you can see that some of these documents, like this certificate of incorporation, it lives in the recap documentation, so Tim will have access to it as counsel for one of the investors. But at the same time, it also lives in your corporate information, which is under Articles of Incorporation and Bylaws, and that particular document you wouldn't have the other documents in that section you wouldn't necessarily have access to. So this document lives in 2 places. That's the advantage of organizing your due diligence content according to a tag structure as opposed to a folder structure. And as a side note, ShareVault is the only virtual data room that supports tag-based organization of due diligence materials as opposed to folder-based. So here's an additional example of a powerful feature that is important in these types of scenarios, is that if I search for a word like anti-dilution, you see that we get a couple of hits here, and it's instant search, even if there are many thousands of documents in your data room. That's part of what we do. Notice that when you do a search, you're able to look at the results of the search. You're able to see the what we call the thumbnails, which makes it very, very visual and clear as to which documents you have, and you can open a document to view the document and do your due diligence. So let's actually take a moment over and take a look at some of the permissioning aspects we mentioned. Now, this Galaxy Equity Partners, double-click on it, you'll see that this group only has access to the 2009 recap. Okay, so they're not going to be able to view all the very details of everything that you've got in the due diligence section until they're happy with what they see in the recap, and then maybe as a staged process you might open it up to for further review. But that's how easy it is to set up permissioning within ShareVault. And then, one of the most important aspects of any due diligence process, whether it's for a refinancing, a fundraising of any kind, or for that matter an M&A process or a licensing deal, is intelligence. Where are we in the process? Who's seen what? Who spent how much time looking at what documents? And we've got lots of reporting tools. I'm just going to focus real quickly on people who have either viewed or downloaded documents in the Galaxy group here. So I'll just do that. Update, and you can see exactly who logged in and downloaded and viewed what files and types of events. So very quick and easy to use, exportable to Excel, and you can use that as an important part of monitoring the process of the due diligence as your process moves forward. So with that, I'd like to just mention that there's plenty of capabilities, flexibility, and ease of use that is important to cover when we talk about ShareVault. I've only touched on just a couple of screens here, so be sure to give us a call. We'll give you phone numbers, or email us to schedule a full demonstration where we can talk to you about the particularities of your application for a data room.
I think we have a few minutes left where we can accept a couple of questions, and you can type those questions directly into the software that you're using in the GoToWebinar, and I will see those. One interesting question has come in regards to the conflicts of interest that you see in down rounds, and these conflicts, by the way, I did not mention them in pay-to-play rounds, but boy, oh boy, did they rear their ugly head in the pay-to-play round. If you're the investor who's proposing a round, and you've submitted the term sheet, proposing that pay-to-play is, you know that it's not going to have an adverse effect on you. You're basically picking the poison that your fellow investors around the table are going to suffer. And the question is, how harsh should you be, or how harsh do you need to be in order to get the round done? And the question came up, how typical is it for clients to get a fairness opinion from some independent advisory firm? And the answer is, in the venture world, not very typical. That is sometimes discussed. Sometimes people will say, geez, we just had a 409A valuation done on our common stock, and that valuation firm came up with a model, maybe even a spreadsheet, Tim. Can we just use that? Can we hide behind the valuation that comes from there? The answer is no. There are accounting and tax guidelines that dictate how a 409A valuation is to be computed. But valuations in private companies is a very subjective thing. Beauty is always in the eye of the beholder. There are too many factors that come into play. So no, I think maybe it's one part cost. These fairness opinions, they're not free, and these are typically companies that are running out of money. I think it's far more prevalent for the insider proposing the round to try to proceed under those protective bullet points that I identified in my slides, and basically to hold their breath and hope that the other investors don't sue. I'll also point out that name and reputation and course of dealing play a significant role here. It's a non-legal point, but investors that pull out a very harsh pay-to-play on other investors can expect to have that gun turned around and used against them at some point in time. It's also not a great way to make friends in the community. These deals are often syndicated, and so it's a small world, and I see that element come up. Sometimes I get a little carried away on the modeling here, and I'll propose cap table models, that are very, very harsh. And I'll have investors say, well, I like what you did. You clearly understood the endpoint we're trying to get to, but I can't have my name tied to that. I think that's going too far. I don't want to do this to other people. Another interesting question came in: does the death spiral ever end? That's a very common question. You saw the circularity, and that's similar to another question I often get, which is, how the heck does Excel solve that? I really kind of glossed over that, and again, that's beyond the scope of this webinar to go into all the Excel tricks. But suffice it to say, using the circular references, tool on Excel using GoalSeek and using the solver add-in that comes from the math add-in pack. We don't use any third-party products here. We just use raw native Excel. You can use all of those tools. And the short answer is the death spiral does end. Sometimes the first iteration through the spiral, your Series D price per share is 50 cents a share. You iterate through the second time and it drops to 47. The third time it goes to 42. And you keep going, and you get closer and closer on the golden rule. The disparity between the ownership percentage on a common stock equivalent basis and the ownership percentage on a dollars invested basis, they get closer and closer and closer to the magic 20%. But you might have to cycle through that death spiral 50 or 80 times, and sometimes the Series D price per share is 4 cents, down from what apparently looked like 50 cents a share. And so sometimes after down rounds like this, you'll notice the Series D investors are paying a minuscule dollar amount, and they're buying massive number of shares, hundreds of millions. And so after the financing is done, we do a reverse stock split to bring the share counts down to a manageable number. Another question was asked about the time savings and the cost savings, and can we quantify the use of a ShareVault room? And I mentioned to you that I can build these cap table models often 10 times faster when I have easy access to the data as opposed to when I do not. Yeah, basically, some law firms, and I sometimes will work for investors on a job where I will tell them, this is a fixed fee. This is what I'll charge to get the deal done. Dirty little secret is sometimes before I give that fee quote, I'll scope it out a little bit, and I'll ask the question, where's the data? Is it in a data room? Is it easily accessible? Because that tells me what degree of pain and suffering. If I have to sit and talk to the CEO, the CFO, the human resources person, somebody in accounting, and talk to the company's law firm, it's a lot of conversations that I have to manage. But basically, the cost savings, comes from if I have access to a data room and someone can provision me those rights and I can jump right into it, you may cut out 15 or 20 hours at my exorbitant hourly rate. Let's see. We've got a couple other questions here. We can take maybe 2 more. There's a question about are the antidilution rights and the liquidation preferences, are they exclusive? In other words, do you only get antidilution? You only get antidilution if you convert, but if you convert, you lose your liquidation preference. So the antidilution adjustments, I think if I understand the question, as a preferred stockholder, you can be entitled to an infinite number of antidilution adjustments. If a company does one down round after another, after another, after another, your conversion rate just continues to get adjusted. While you're also a preferred stockholder, you have that liquidation preference or the right to be paid back before common. If at any point in time in the company's history, it's like a good event happens, like the company is going public and all of the preferred stock gets converted into common, you get converted at the conversion rate that was in effect at the time of your conversion. So you get the full benefit of all the antidilution adjustments. If you started out buying a Series A that was 1-to-1 convertible and it went through 13 different down rounds, this is an extreme example, where it ended up being convertible 1 share into 5 shares, you're going to get 5 shares of common stock right before the IPO. The flip is that when you convert to common stock, although you enjoy the benefit of all your prior antidilution adjustments, you don't get any more in the future going forward. And similarly, if you ever convert from preferred to common before an acquisition, you obviously are giving up your liquidation preference. You'd be very happy to do that in the case of an IPO. You'd be very sad to convert to common stock before an acquisition and then have the company go through an acquisition and watch the lion's share of the proceeds go to preferred stockholders and not to you. Our last question here we can cover is what happens if in a later stage financing you're doing an up round and you're looking to change liquidation preference of the prior rounds. What is the quote-unquote typical or market treatment of the prior rounds? Well, the short answer here is if you're doing an up round, something's going okay. The company must be executing according to plan, or it must have hoodwinked yet another investor into believing that it's worth at least what the prior investors put in. So it would be unusual in an up round or even in a flat round that's done at the same valuation as the last round. It would be unusual if you were looking to change the liquidation preferences. But I can imagine that scenario in which people say, you know, the new investor is, let's say, a strategic investor, and ownership interest is not really important to them. What they really want is to own some small stake in the company, so for public relations purpose, they can say we own a piece of this startup company. But there's actually a commercial agreement, a supply agreement, or an IP license agreement on the side, which is the real strategic benefit. So sometimes those strategic investors sort of say, I don't care about price, you know, whether I own 3% or 7%, I really don't care. If you will resell our products, or if you will buy this volume of products and we can say that we own a piece of you, I'm happy. So sometimes in those circumstances, I could see the management team saying, wow, the preference has really piled up on us, and we've got an undermotivated you know, team here of option holders. You know, in that case, it's often just a preference reset that I described. To me, the most fair thing, the least objectionable, the least upsetting proposal is to have everybody's liquidation preference ratably scaled back as a percentage basis. I'm not used to seeing things where, you know, Series C will take the brunt of the burden because they invested at some super, you know, some super high or some super low valuation, and they're to be punished, with Series A and Series B not suffering the same fate. So it's often just a percentage-based reduction. Last thing that I'll add is if you're not treating people the same, you got to watch out for specific series votes, and you got to watch out for litigation. So do you expect a company to have a ShareVault data room even when it does not anticipate a transaction, but just as good preparation, or as I call it, good corporate hygiene? Yes, I do. I cannot imagine a better way to scare away. You know, lawyers are all about rigor and are all about discipline and are all about rules and order. And I can't imagine a better way to scare away investors' counsel or an investor than to present your house in horrible disarray, chaos, and disorder. If that's the way your corporate administration is, you know, just think about the way your, you know, your trade secret protection is or your employment practices are. It just benefits you. It just benefits you tremendously. The costs are not prohibitive. It benefits you tremendously to keep your house in order. You know, if you think you can do all this in paper, you know, let me know how things are going in the 1980s these days. But in this day and age, it's all done electronically, and if you can turn on a dime and say to a potential new investor, sure, I'll let you into a couple rooms or a couple folders in my data room, and if an unsolicited acquisition offer comes along, you don't want to be the CFO or the director in the finance department that says, oh crud, I need to stay late tonight, I need to figure out what our cap table is and how many options we have outstanding. That, you know, that's changing every day at your company. There should be one place that you go to get all that. There's sort of no excuse for letting your checking account go unbalanced, you know, more than 1 month. And there's sort of no excuse to let your corporate records, you know, fall into disarray.
Okay, thank you very much, Tim, and thanks, Mike, for the introduction. I think we're wrapping up here on the webinar. I want you to let everyone know that we really appreciate the time you spent attending the webinar. We believe that it was a valuable content that Tim provided, and we hope that you all learned something important. The webinar will be available via our website. You'll receive a link to that, so you can go back and watch it. And additionally, Tim has generously offered to allow us to distribute the slides themselves. You will all receive an invitation to click through into a ShareVault data room that contains the webinar for you to download. And in that way, you'll be able to play around a little bit with a real ShareVault, although you won't be an administrator, you'll be an end user, and you'll be able to download that presentation from there. So thanks again, and we'll look forward to seeing you at the next webinar.